Welcome, curious minds, to another deep dive.
Great to be here.
Today, we're pulling back the curtain on something really fundamental, financial markets.
Absolutely. Core stuff.
Yeah, we hear these terms all the time: stocks, bonds, brokers, market makers. But what do they actually mean? Like in the big picture,
Mm-hmm.
why should you care?
Mm.
Our mission today is to, well, demystify it. We want you to understand the basic purpose of the securities industry, who the main players are, and, how it all kind of works behind the scenes.
Yeah.
Okay, let's unpack this.
And it's so important, really, whether you're just starting out thinking about finances or you're already, involved.
Right.
This kind of understanding is foundational. It's the sort of thing you'd cover for, say, an industry exam. But honestly, it's more than that.
More practical.
Exactly. We're hoping for those aha moments, when you see how these different pieces, issuers, brokers, markets actually connect. It's quite a system when you see it laid out.
Totally. So let's kick things off with the absolute core idea. Why does this whole securities industry even exist?
Right.
You called it a bridge for capital needs. I like that analogy.
It really is. The primary purpose, fundamentally, is matching investors, people, or institutions with money, with capital, to issuers who need that money.
Okay, so who are these issuers?
An issuer is basically any legal entity selling securities to fund what they do. It could be a business needing cash to grow or, the U.S. Treasury borrowing for government spending.
Or even like state governments, local governments.
Absolutely. State and local governments issuing bonds for infrastructure, schools, that sort of thing.
Right.
Corporations raising money, banks too. They all need capital for various reasons: expansion, paying bills, new projects.
Okay, so they need the cash. How do they actually get it through this bridge? What are the main ways they raise capital?
Well, there are two primary methods. First, they can issue debt securities. We usually just call these bonds.
All right, bonds. Heard of those?
Yeah. It's essentially a publicly traded loan. The investor buys the bond, so they become a creditor, lending money to the issuer.
Okay.
The issuer promises to pay that money back, the principal, at a set date in the future, the maturity date. And usually they make interest payments along the way.
And if they don't pay?
That's called the default. Big trouble for the issuer if that happens.
Gotcha. Okay, so that's debt. What's the other way?
The other main way is issuing equity securities, which are stocks.
Ah, stocks. Ownership, right.
Exactly. When you buy stock, you're buying an ownership slice of the company. You actually own a piece of it.
So you share in the profits?
Maybe, yeah. If the company does well and decides to distribute profits, shareholders might get dividends. But unlike bond interest, dividends are usually voluntary. The company doesn't have to pay them.
And stocks don't have that maturity date like bonds.
Nope. No maturity date. You own it until you sell it. Or, well, the company ceases to exist.
Okay, that's a really key difference then. Lending versus owning.
Huge difference.
Yeah.
Different risks, different rewards.
So, who builds and operates this bridge? Who connects the issuers needing money with the investors who have it? You mentioned financial firms.
Exactly. The main connectors are financial firms, primarily broker-dealers and investment advisors.
Okay, let's tackle broker-dealers first. That name sounds like they do two things.
They do. That's why the name is hyphenated. A firm can act as a broker. In that role, they're an agent, acting for others.
Okay.
They match up buyers and sellers. They don't own the security themselves in the transaction. They just facilitate it. And for that service, they earn a commission.
You mentioned the real estate agent analogy before.
Yeah, that's a pretty good way to think about it. They find the buyer for your house or the house for you and get paid a commission.
Okay, so that's the broker part. What about the dealer part?
As a dealer, the firm acts as a principal. This means they trade for their own account.
Ah, okay.
They might buy securities from you and hold them in their inventory, or sell securities to you from their inventory.
Like a car dealership.
Exactly like a car dealership. The dealer buys cars, puts them on the lot their inventory, and sells them for more than they paid. Or they buy your used car to add to their inventory.
So how do they make money as a dealer?
They earn a markup when they sell from their inventory, selling higher than their cost. Or they earn a markdown when they buy into their inventory, buying lower than the current market price. It's about the price difference, the spread.
And firms often do both, broker and dealer activities.
Very often, yes. That's why we just call them broker-dealers. It covers both capacities.
Makes sense. These sound like pretty complex operations. How are they structured inside? What kind of departments do they have?
Oh yeah, large broker-dealers are multifaceted. You've got investment banking, or IB. These are the folks working directly with issuers on new offerings, mergers, acquisitions, that sort of thing.
Yeah.
Underwriting deals.
Okay.
Then there's research. analysts who dig into companies and markets, and they issue those buy, sell, hold recommendations you hear about.
Yeah.
You have sales. These are often the registered reps or investment advisor reps who talk to clients, both individuals and institutions, about products and strategies.
The client-facing side?
Exactly.
Mm-hmm.
Then trading. These guys execute the trades, both for clients and sometimes for the firm's own account. That's called proprietary trading.
Okay.
And crucially, operations. They handle all the behind-the-scenes stuff, the paperwork, making sure money and securities move correctly, setting out statements, keeping assets safe. They're vital.
Wow, okay. Lots of moving parts. Now, you mentioned market makers earlier. Are they a special kind of broker-dealer? What's their specific job?
Yes, a market maker is a broker-dealer, but with a specific function. Their job is to provide liquidity in the market for certain securities.
Liquidity meaning make it easy to buy or sell.
Precisely. They do this by displaying quotes, basically prices. They show a bid price, which is the price they're willing to buy the security at.
Okay.
And they show an ask price or offer price, which is the price they're willing to sell the security at. So you might see a quote like $10.01 bid, $10.06 ask.
So they're always ready to trade.
That's the idea. They also quote a size like they'll buy 1,000 shares at the bid and sell 2,000 shares at the ask. By standing ready to buy and sell, they ensure there's usually someone to trade with, which keeps the market moving smoothly.
How's that different from just any trader?
A regular trader buys and sells for profit, either for themselves or clients, but they don't have that obligation to continuously quote prices and provide liquidity like a designated market maker does for specific stocks.
Got it. Okay, so market makers are key broker-dealers for market flow. Now, the other main type of firm you mentioned was investment advisors. What's the core difference there? How do they fit in?
The biggest difference is really about how they're paid and their primary function. Remember, broker-dealers typically earn commissions for executing trades.
Right. Transaction-based.
Exactly. Investment advisors, on the other hand, primarily charge fees for giving advice.
Ah, advice, not trades.
Right. The advice could be about portfolio construction, financial planning, specific investments. Their fees are often a percentage of the assets they manage, for the client known as assets under management, or AUM.
And they get paid that fee whether they trade a lot or a little?
Generally, yes.
Yeah.
The fee is for the ongoing advice and management, not typically tied to the number of transactions. And these firms range hugely in size, from giant firms managing mutual funds to small local advisors.
Okay. And you also mentioned municipal advisors, a special type.
Yes, that's a specialized role. Municipal advisors advise municipal entities, think states, counties, cities, school districts.
So they advise the issuer, not the investor.
Exactly. Their client is the government entity that wants to issue bonds, maybe for that new school gym you mentioned earlier.
Ah, okay.
They help the municipality with the whole process, structuring the deal, timing it right, figuring out the terms. They work for the town, not the people buying the bonds.
That's clear. Okay, so we have the securities, we have the firms acting as the bridge infrastructure. Now let's talk about the different types of investors using this bridge.
Right, the investors. We can break them down into a few key categories. First, you have retail investors.
That's most people, right? Regular folks.
Pretty much, yeah. Individuals investing their own money, maybe through a single account, a joint account with the spouse, retirement accounts like IRAs or accounts for kids. The key thing is, securities regulations are primarily designed to protect these retail investors.
Because they're seen as less sophisticated, maybe? Or have less money at stake?
Generally, yes. Anyone who doesn't fit the definition of an institutional investor usually falls into the retail category.
Okay, then who's next?
Next up, you have accredited investors. This is an SEC category for investors deemed more sophisticated or financially able to handle higher risk investments, maybe those not registered with the SEC.
So who qualifies as accredited? Is it just about being rich?
It can be about wealth or income or position. It includes big players like financial institutions, large pension plans, certain development companies, but it also includes individuals who meet specific tests.
What are the tests for individuals?
An individual can be accredited if they meet either of two criteria. One is net worth, over $1 million, excluding the value of their primary home.
Okay, $1 million net worth. Or
income, an annual income over $200,000 for each of the last 2 years. Or $300,000 combined income with a spouse for those 2 years. And crucially, they need to expect that income level to continue.
Got it. A net worth or income test. Are directors or officers of the company selling the security also accredited?
Yes, directors, executive officers, or general partners of the issuer are also considered accredited investors.
Okay. So retail, then accredited. What's after that?
Institutional investors. These are the big players, large organizations that pool money to invest. Think banks, insurance companies, pension funds, university endowments, hedge funds. They trade in large volumes.
And is there an even higher level?
There is, yes. A specific subset of institutional investors called qualified institutional buyers, or QIBs, pronounced QWEB.
Two IBs. Okay, what makes them special?
The SEC has a strict three-part test for QIB status. It's designed for the really big, sophisticated institutions.
3 parts. What are they?
First, the entity has to be one of certain eligible types: insurance companies, registered investment companies, registered investment advisors, large pension plans, corporations, etc. There's a specific list.
Okay, type of institution matters.
Second, they must be buying securities for their own account or for the account of another QIB.
Right.
And third, this is the big one, they must own and invest on a discretionary basis at least $100 million in securities of issuers that aren't affiliated with them.
Wow, $100 million. That's a high bar.
It is. And a key point, individuals, even very wealthy accredited investors, can never be QIs. QIB status is only for entities.
So QIBs are strictly institutions with huge investment portfolios.
Exactly. And these distinctions, retail, accredited, institutional, QIB, are really important because regulators often create different rules and allow access to different types of investments based on these categories.
That's fascinating. The rules of the road change depending on who you are, essentially. Okay, so we have the bridge, the firms, the travelers. Where does all this trading actually happen? Let's talk market structure.
Right, the where. We basically have 2 main market environments. First is the primary market.
Primary, meaning first.
Exactly. This is where securities are first sold, brand new issues. When a company does an initial public offering, an IPO, that happens in the primary market.
Ah, okay.
The company, the issuer, sells its stock or bonds, usually through an investment bank acting as an underwriter, directly to the initial investors. The key here is the money raised goes to the issuer.
To fund their business or whatever they need it for?
Precisely. It's the first time that security is offered to the public, and this process is heavily regulated, mainly by the Securities Act of 1933.
Okay, so that's where securities are born. What happens after that?
After they're issued in the primary market, they start trading between investors. That happens in the secondary market.
Secondary. Secondhand, kind of.
You could think of it that way. It's where existing securities are bought and sold. When you buy shares of, say, Apple on your brokerage app, you're trading in the secondary market.
And the money doesn't go to Apple in that case?
Nope. The money goes from the buyer to the seller. Apple already got its money when the shares were first issued way back when. The secondary market is all about investors trading amongst themselves.
Gotcha. So within this huge secondary market, are there different kinds of venues, places where the trading happens?
Oh, absolutely. There are several distinct types. The most familiar are probably the exchange markets.
Like the New York Stock Exchange, NASDAQ.
Exactly. These are centralized trading venues. Historically, the NYSE was a physical trading floor, though now it's more of a hybrid electronic system. NASDAQ has always been electronic, but it's still considered a national exchange.
And stocks have to meet certain requirements to trade there.
Yes. Companies have to meet listing standards, size, profitability, governance rules to have their securities traded on a major exchange. We call these listed securities. Trading is generally very transparent.
Okay, exchanges for listed stocks. What about stocks that aren't listed?
Those trade in the dealer-to-dealer market, which is usually called the over-the-counter or OTC market.
Over-counter.
This is for unlisted securities, often called OTC equities. These might be stocks of smaller companies or companies that don't meet exchange listing standards. There's no central physical location.
So how does trading happen? Phones, computers?
Mostly electronically now, through dealer networks. You might hear names like the OTC Bulletin Board, OTCBB, or the Pink Marketplace. These systems display quotes for OTC stocks.
Are they regulated like exchanges?
Not exactly. They aren't registered as national securities exchanges with the SEC, and there's generally less information available and less trading volume compared to the exchanges.
Okay, what about bonds? You said debt earlier. Where do they mostly trade?
That's a key difference. Most bonds, corporate bonds, municipal bonds, U.S. government bonds, trade primarily in the OTC market.
Not on the exchanges like stocks.
Mostly not. The bond market is largely an OTC dealer-to-dealer network. Trading often happens in large blocks between institutions. Some specific types, like convertible corporate bonds, can trade on stock exchanges. But the vast majority of bond trading is OTC.
Interesting. So the bond world is kind of its own separate OTC universe.
Oh,
Okay, now, here's where I think it gets really interesting. Beyond the main exchanges and the standard OTC market, you hinted there are other ways trading happens, maybe less visible ways.
yes, that's right. The market structure has evolved quite a bit. We have what's known as the third market.
The third market, what's that?
This involves exchange-listed securities being traded over the counter.
Wait, listed stocks trading away from the exchange where they're listed? How does that work?
Exactly. Broker-dealers can match buyers and sellers of listed stocks directly, away from the exchange floor or main electronic book. This market has grown a lot, especially for large institutional orders or for trading outside of regular exchange hours.
So institutions can trade big blocks of NYSE stocks without going through the NYSE directly.
Essentially, yes, facilitated by broker-dealers acting in that OTC capacity.
Okay. Third market. Is there a fourth?
There is. The fourth market. This is even more direct. It's institution-to-institution trading, completely bypassing the public markets and broker-dealers acting as intermediaries.
So, like one big pension fund trading directly with another big insurance company.
Precisely. Sometimes it might just be portfolio managers arranging trades directly, but more often it's facilitated electronically through what are called proprietary trading systems, or PTSs, often run by broker-dealers to internally match or cross large institutional orders.
Does this affect regular investors much?
Largely no. The fourth market is mostly invisible to the average retail investor. It's about large institutions moving big positions efficiently.
Okay. Third and fourth markets. Any other important venues?
Yes. We also need to talk about electronic communication networks, or ECNs.
ECNs, what do they do?
Think of them as electronic matchmakers. They're market centers that run electronic systems to match buy and sell orders for securities, primarily listed ones.
So they compete with the exchanges, kind of.
In a way, yes. Subscribers, often broker-dealers or institutional traders, can post orders directly into the ECN. They allow for fast execution, sometimes anonymous trading, and they often operate outside of standard market hours. They charge fees and act purely as agents, matching orders.
Got it. Electronic order matching systems. One more category I've heard about. Dark pools. Sounds mysterious.
It does, doesn't it? Dark pools are trading systems, often run by broker-dealers or even exchanges, that provide liquidity, mostly for large institutional orders and high-frequency traders. But the key is, they do not display the quotes publicly.
Ah, hence dark. You can't see the orders waiting there.
Exactly. The orders are hidden until they're executed. The goal is to allow institutions to trade large blocks of stock without revealing their intentions to the broader market, which can cause the price to move against them before they finish trading.
So it minimizes market impact for big trades.
That's the main benefit, yes.
Yeah.
Anonymity and reduced market impact, often with lower transaction costs, too. They might match orders automatically or allow some negotiation.
Okay. Wow. That is a whole hidden layer. Exchanges, OTC, third market, fourth market, ECNs, dark pools. It's more complex than just the stock market.
It really is.
Which raises a big question. Why do all these alternative venues exist, and what does it all mean for how the market actually works for everyone?
So we've covered a lot of ground, from the basic why the market is a bridge for capital to the firms building that bridge, broker-dealers, advisors, then the different investors traveling on it, retail, accredited institutions, QABs.
Yeah, the whole spectrum. And finally, this whole fascinating array of places where the trading happens. Public exchanges, OTC, and these, well, less visible third, fourth markets, ECNs, and dark pools.
It's quite the ecosystem.
It really is. The core idea seems to be this complex, interconnected system, always adapting, all designed to get capital flowing. So what does this all mean for you, the listener?
Yeah, I think even if you're primarily a retail investor, just managing your own savings or retirement account, understanding these layers, it gives you a much, much deeper appreciation for what's actually happening behind the scenes.
Right, it's not just numbers flickering on a screen.
Exactly. Knowing about primary markets helps you understand IPOs. Knowing about institutional players and venues like dark pools helps you contextualize market movements sometimes. It helps you recognize who the different actors are, what might be motivating them. It just fosters better critical thinking when you consume financial news or make investment decisions.
Yeah, context is everything. And maybe a final thought to leave folks with. As technology keeps changing everything, How might these dark venues, these alternative trading systems, continue to shape things? Will they make investing more efficient or maybe less transparent? How does it affect accessibility for everyone, not just the big institutions?
That's the ongoing question, isn't it? The balance between efficiency for large players and transparency for the overall market. It's something regulators and market participants are constantly grappling with.
Definitely something to keep an eye on. Well, we hope this deep dive has shed some light on the complex, sometimes hidden, but absolutely vital world of financial markets.
Hope it sparks some curiosity.
Absolutely. Until next time, keep exploring.